Four of my favorite long-term stocks reported impressive and unexpected earnings yesterday. I've said this hundreds of times, these stocks are those you just have to buy and buy and buy and hold for the long term and never sell them or trade them. These stocks are the big tech companies, the FAANG group plus Microsoft. But today, I will only talk about Facebook, Apple, Amazon, and Google since they reported earnings yesterday. I will go through their financials, expectations, show my positions, and explain what I'm going to do with these stocks. So please smash that like button and subscribe since it really helps my channel out. Also remember to claim your 2 free stocks with Webull by just opening an account with them and depositing $100, which you are able to withdraw later on when you receive your 2 free stocks, so it is basically free money. The link for that is the first one in the description below. So let's get started. First, Facebook, with a market cap of $800 billion, is trading at a price of $280 per share. Sorry guys, while editing the video I noticed that Facebook stock is actually at $261 per share and has a market cap of $744 billion since it has dropped almost 7% today. They reported revenue growth of 22% year over year with a revenue of $21.4 billion and earnings of $7.8 billion, which is an excellent growth of almost 30% year over year. Their daily active users grew 12% year over year and monthly active users 12% as well. As you can see, Facebook has a very steady, constant and excellent growth on their active users, both in their daily and their monthly users. Their average revenue per user has increased in all their segments in the US and Canada, Europe, Asia and Pacific, and the rest of the world, which is obviously impressive since they are a huge company and continue having such an excellent growth year over year in every single aspect. As you can see, they beat analyst expectations on every single metric. They beat earnings, revenue, daily and monthly active users, and in their average revenue per user, which obviously it is impressive. I have always said that Facebook has one of the best and most healthier balance sheet than any other company. They have cash and cash equivalents of $11.67 billion, which yes, it is lower than where it was in December 2019, but still it's a huge amount of money. Have total assets of $146.4 billion and total liabilities of $28.7 billion, meaning that they only have 19.6% of their assets financed with liabilities. But the most impressive thing about Facebook is no debt. Facebook has no debt in their balance sheet. Analysts are expecting a revenue growth of only 13.8% for this year, but 24.4% for next year, 2021. At the moment, I have a 7.45% of my portfolio in Facebook with an average cost of $198.99 per share and a return of 40.71%. And it's a stock I do want to continue adding to my position. The next stock in this list is Amazon, the king of e-commerce and one of the best growth tech stocks. Amazon has a market cap of $1.52 trillion and is trading at a price of $3,037 per share. They reported a total revenue growth of almost 38% year over year since they reported a revenue of $96 billion. $96 billion. That is a huge amount of money for Amazon. Their North America section grew 39% year over year and then a 37% growth year over year for their international sector. But the most impressive thing of all this is that their net income for the international sector grew 205% year over year since it went from a loss of $386 million to an operating income of $407 million. That is a huge turnover for Amazon. For their AWS, which is their cloud-based segment, they had a revenue growth of 56% year over year. After all that said, you can see here that they beat both revenue and earnings analyst expectations. Analysts were expecting earnings per share of $7.41 and Amazon reported earnings per share of $12.37, which is impressively unreal. We do have to take into consideration that Amazon is able to control their earnings. I am sure that they are able to control their profit margin in every sector, and also if they want to invest more money, they invest. If not, then they save more money, and that is how they are able to beat analyst expectations by almost 67%, which let me tell you that is a huge beat. Obviously, Amazon is one of the companies, if not the one, that has benefited the most from the pandemic, and still they expect to face even greater demand heading into the holiday season. We are seeing more customers than ever shopping early for their holiday gifts, which is just one of the signs that this is going to be an unprecedented holiday season. Amazon has $29.9 billion in cash and cash equivalents, which has decreased since December 2019. They reported total assets of $282 billion and total liabilities of $199 billion, which means that they have 70% of their assets financed with liabilities. Analysts are expecting a revenue growth of 31.8% for this year and only 18.3% by 2021. I do have to say that Amazon is my favorite stock from this group. It is also the biggest position in my portfolio, which obviously is not recommended to have that much of your portfolio in just one stock, but I feel very comfortable with Amazon. This stock represents 41.58% of my portfolio, and I have an average cost of $1,663 per share, which means that I'm almost 84% up, and still think that in the long term it is an excellent investment. If it gets below $3,000 or even better $2,500, it would be an excellent investment. The next stock in this group is Apple, ticker symbol AAPL, which has a market cap of $1.86 trillion and is trading at a price of $108 per share. Now, Apple's fiscal year is already over, meaning that yesterday's report was their Q4 and annual earnings report for their fiscal year 2020. Let me show you really quick how they did on a quarterly basis and then on a yearly basis. On a quarterly basis, they reported a slight beat on earnings per share since they reported 0.73 cents, while analysts were expecting 0.70 cents, and then they reported $64.7 billion, beating analyst expectations as well. As you can see, the stock dropped more than 4% after hours, and it is because their iPhone revenue was $26.4 billion, while analysts were expecting a revenue of $27.9 billion, meaning that their growth is slowing down. They beat analyst expectations in services, other products revenue, and reported a massive growth of 28% for their Mac sales and 46% for their iPad revenue year over year, which would assume it is because of so many people working from home and watching classes online. Now, on a yearly basis, they reported a revenue of $274.5 billion, which is a growth of 5% year over year. Their service segment grew 16%, while their product service grew 3%. I do have to say that I would expect next quarter to be impressive and also expect an excellent year coming up, even more when their iPhone 12 and 12 Pro were a success the very first day, surpassing iPhone 11 sales. Apparently, Apple sold up to 2 million iPhone 12 units in the first 24 hours, while last year they sold 800,000, which is 150% growth year over year, and that is impressive for such company as Apple. Apple has a good balance sheet as well, since they have $38 billion in cash and cash equivalents, down from $48 billion last year. Still, Apple has total assets of $323.8 billion and total liabilities of $258 billion. As many of you may know, I am an Apple addict and Apple shareholder. I invested in Apple when I started investing and then sold it for a profit, which maybe was not the best decision in my life, but then I started investing again. Currently, Apple represents 2.98% of my portfolio since I started investing about a month or two ago, and has an average cost of $114.19 per share, which means that I'm down 4.80% in my position. I do think this downtrend in the market is creating good opportunities to invest in excellent companies, but also to average down my positions. This is exactly what I do not invest all I have available for a specific stock at once, since I'm looking to average down and have a way better average cost. I like Apple at this price, and if it goes below $100 per share, would be way better. The last stock in the video is Google's parent company, Alphabet. It currently has a market cap of $1.1 trillion. They reported a total revenue of $46.1 billion, which is a growth of 14% year over year, beating analyst expectations by 45% in earnings per share. Their YouTube ad segment grew 32% year over year, their Google advertisements grew 9%, and their cloud almost 40% year over year. Google also has a good balance sheet with a total cash and cash equivalents of $20 billion, up from $18.5 billion last year, have total assets of $299.3 billion and total liabilities of $86 billion, which means that they only have 28.8% of their assets financed with debt. Google is the only stock in this video that I'm not a shareholder of, but have been waiting to start a position for a while now. Really, I can't say why I haven't, since I think it is because I've been focusing on other stocks, but still think that it is an excellent investment long term. Now, in this chart that I created, we can compare these companies according to their revenue growth, current valuation, and balance sheet. As expected, Amazon is the one with the best growth year over year, while Apple is the lowest one. Then, for their balance sheet, remember that the lower the total asset to liability ratio, the better. So for this segment, Facebook for sure has the best balance sheet in the group. Now, all of them have good balance sheet with billions of dollars in cash and cash equivalents, but Facebook has a way stronger and healthier balance sheet in the group. Last but not least, their valuation according to Yahoo Finance. Facebook has a forward PE of 25.38, Amazon 57, Apple 28.9, and Google 27.17. Obviously, these are not the cheapest valuation of any of these companies, but this downtrend is definitely creating a huge and very exciting opportunity to invest in these companies. Now, remember that I'm not a financial advisor, but I do think that all of these stocks are excellent investments right now if you are thinking long term. In my opinion, these are stocks that I will or should always have in my portfolio, since they are the tech leaders, have good valuations, excellent company management, money management, and could give me a good return in the long term. I really hope you enjoyed the video. Remember that I have a completely free Discord group chat, which the link for that is down in the description below. Please smash that like button and subscribe, since it really helps my channel out. Thank you, and see you next time.